Terms like finance, capital, and management might sound a little complex, but not getting the basic idea can be a serious problem. Understanding balance sheets and financial terms might seem intimidating, especially if numbers aren't your strong suit. Yet, making smart financial decisions and being able to explain them confidently is important nowadays, especially for professional growth. And when the financial system does these things well and doesn't cost too much, it helps the whole economy. Studies have found that countries with strong financial systems tend to grow faster than those where finance is less important. At the very first, remember, accounting and finance are connected but have distinct roles. In accounting, when you buy equipment, you record the payment and its value is spread over time. Profits can be influenced because this process is subjective. Finance, on the other hand, looks ahead and focuses on cash flows. Most money experts think the cash flow statement is a really crucial financial document for a company. It usually has three parts. One about day-to-day activities, another about investments like buying stuff, and a third is about how the company gets its money through loans or stocks. And here, free cash flow is the most straightforward way to see how much cash a company has. It's the cash that the company can freely use or share however it wants, and it's a key factor when figuring out the company's overall value. Free cash flow is the money a company has available after covering its basic expenses and taxes. It's calculated by adding up earnings before interest after taxes, which is essentially the profit left after tax payments and depreciation and amortization. And then you adjust this total by considering changes in working capital and capital expenditures. In simple terms, free cash flow reflects the actual cash a business can use for investments, debt repayment, or other financial activities. Now, to create value in finance, managers should focus on positive NPV projects, meaning projects that generate more cash than they cost. The key is deploying assets wisely, not relying on financial tricks. Net present value, shortly known as NPV, is a way to evaluate investments. It sums up all current and future cash flows adjusted for time using a discount rate. In simpler terms, it calculates the present value of expected cash returns over time, helping managers decide if an investment is worthwhile. Let's now talk about the cost of capital here. The cost of using money comes from both borrowing debt and ownership equity. Debt has a fixed repayment, while equity's return varies. The weighted average cost of capital, or WACC formula, considers both. Debt cost, RD, is the interest rate, and equity cost, RE, is found using the capital asset pricing model. Remember, these costs reflect what investors expect to get back. More risk means higher returns. Risk is about the investment, not who invests. Another important part of finance is the valuation. Valuing a business is an art, not a precise science. Two main methods are multiples like the PE ratio and discounted cash flows. Enterprise value considers both debt and equity. The discounted cash flow method calculates the present value of future cash flows. From the business's overall value, or let's say the enterprise value, you find equity value by considering debt and cash. Always pay less than the expected value, otherwise you're not creating value. Moving on to the next is capital allocation. Deciding what to do with cash is a key CFO and CEO challenge. Should they invest, acquire, or distribute to shareholders? Remember this, dear viewers, smart capital allocation can create or destroy value. And last but not least comes working capital. It's critical to manage working capital, or the money required for regular business operations. The cash conversion cycle measures how long it takes to turn investments into cash. If a company has a negative cash conversion cycle, it means it can grow without needing outside money because its suppliers help support their expansion. Moreover, a robust finance idea forms the backbone of sustainable business growth, akin to a well-constructed building foundation. It empowers your business to thrive and endure, providing stability in the dynamic landscape of commerce.